Good morning, everybody. I'm Brian Pascoe, the new Chief Executive of ICMA, and it's a real pleasure to be here today to introduce the 15th Primary Market Forum for the ICMA. I am new in the role, but I'm certainly not new to the primary markets. I've spent close to 30 years in the financial markets overall as part of my career, and the vast majority of that was in the debt capital market space with HSBC. I worked across both Europe and Asia and had some extremely interesting experiences setting up capital market operations in Asian regional currency markets, all the way through to managing the global debt capital market team at HSBC across the entire spectrum of our primary market activities. So this is an area that's very, very close to my heart and somewhere that I feel very familiar, and also an area clearly for ICMA that is central to our core purpose. And I know how important this forum has been in the past. I look forward very much today to listening in to the panel discussions and hearing your views on how the market is evolving. Of course, this is the second time that we've met virtually, but the good thing about the virtual format is that it means that we can incorporate our partners, our sponsors, our members, and interested parties from Asia Pacific and the MENA region, as well as Europe. And this is really an annual event, which is a great opportunity for us to gather also our membership and our stakeholders from across the value chain, be they issuers, investors, intermediaries, infrastructure providers, advisors, technology firms, and others. It's really important, actually, for ICMA's mission to bring everybody together across these constituent parts. Of course, we do that on a day-to-day basis, also bringing together sell side and buy side, and issuers together through forums and working groups and committees on an ongoing basis. To us and to me personally, again, the primary market constituency is of significant and leading importance to ICMA. The effectiveness of our primary markets business has long been central to our core purpose, actually, of promoting resilient, well-functioning, international, globally coherent cross-border markets. And that's really been evidenced by the continual updating of the primary market handbook, which still really acts as a de facto Bible for the operations in the primary markets across the globe. The primary markets obviously are playing an increasing important role in the development of the sustainable finance agenda and mobilizing money into socially and environmentally important causes. We've seen huge increases there in the course of the year of volumes, over 80% in the course of the first 9 months of this year. And that's been really very much coupled with the general conventional markets, which clearly even through the pandemic have been central to ensuring that corporates, that banks, that governments and other SSA issuers have had consistent access to international money. It's been very clear that the capital markets have played a key and consistent role through that process. As we look ahead, we're also going to see the increasing embedding of technology and FinTech into all of the developments across the capital market space. These are very exciting times around this area, but also challenging to the extent that we need to be very clear that fragmentation is also a risk as part of this process. I do think strongly that this is going to be a very important agenda item for ICMA going forward, and we can really play a role in ensuring enhanced standardization and cohesion as much as possible. So all of these new developments, the digitization processes, electronification, are very much additive to how we work across the primary markets and indeed across the entire securities lifecycle. The agenda for today actually reflects all of these key themes that we face in the primary market community. Our first panel will focus on issues related to sustainable finance. This is a continuously central and prominent agenda item for ICMA. It pervades all areas of our involvement and many, if not all, actually, of our committee engagement, membership engagement forums these days. It's very rare that I will call in to a committee meeting, and sustainable finance won't be one of the most important topics that's discussed. We have played and will continue to play a very important role in this, with significant regulatory engagement across jurisdictions, certainly in particular around the reporting and taxonomy element of the developments in that market. Digitization of primary markets globally, as I've mentioned before, is a critical element to how we think about our business. On our second and third panels today, they'll both address topics related to digitization of the primary markets. There are a wide variety of initiatives across this space, ranging from automation of specific verticals, be they roadshows, documentation elements, book building, and also things which cross-cut the entire primary market business. And the digitization of securities on distributed ledgers and other ways and means of bringing things together. Our directory for ICMA, our Primary Markets Technology Directory, already includes close to 50 different startups and initiatives that cover the whole spectrum of the primary markets. A key area for us is common data standards to promote the straight-through processing, enable interoperability. And as I mentioned before, creating as much standardization as possible is very important in this space. We'll also talk about the dynamics and regulatory change within the market. Particularly in our second panel, we'll discuss the busy new issue market and the economic and regulatory changes that are constantly affecting it. We see in Hong Kong, for example, the SFC's consultation on book building, where ICMA has played a very important role in engaging with the SFC on behalf of our members and with consultation with many, many stakeholders to ensure that we can have an important seat at the table and be an important element of the discussion and the thought processes with the SFC to ensure that the impact of that consultation and the plans are as friendly to market activity as possible and not disruptive, because clearly this initiative could have significant cross-border ramifications. In Europe, the markets and authorities continue to adjust to the post-Brexit landscape as well. ICMA has supported its members throughout this process with updated standard language, for example. We're engaging with both the EU and the UK authorities on the regulatory changes that are emerging to try as much as possible to ensure that we're able to smooth over any issues that emerge from divergence of regulatory standards. In the space of ICSDs, we'll also hear today from Euroclear in a brief presentation, who will discuss the changes that the ICSDs are due to make to the way that syndicated bonds are settled. I would like to thank you all. Our ICMA primary markets work continues to be very busy, and we would not be effective without the significant time commitment of the chairs and the members of our committees and other groups in Asia and Europe. I thank you very genuinely for all your time and effort to make sure that these forums, working groups, committees come together in an effective and positive way. We're also very grateful to the law firms that provide us and the broader primary markets community with a significant amount of pro bono support. And in particular, I'd like to thank the teams at A&O, Clifford Chance, and Linkletters. Finally, I'd just like to remind everybody that the forum will be operating under Chatham House rules, which means that you're free to use the information received, but not able to discuss the names of individuals or their affiliations of anyone on the panels or making discussion points, nor to divulge the names of any of the people participating or present during the event. So with that, we have a very packed agenda, I think, today, full of very important topics that we need to cover off. And I will pass on with that to Katie Kelly, who will host and moderate our first panel on sustainability.
Thank you very much, Brian. Just want to check that all my panelists are now revealing themselves. I think, just check, I can see Lars, Lu Ying, Johanna, and Matthew. I think we're all good to go. So thanks, Brian. Thanks for your introductory comments there. I'm Katie Kelly. I'm Senior Director in Market Practice and Regulatory Policy at ICMA. And just following on from Brian's introductory remarks, as sustainability takes to the global stage in the UK next week with the hosting of COP26 in Glasgow, and all the hoo-ha that's creating in the UK. And obviously the UK has just released its green finance roadmap to accompany that. So very strong signals of intent here. But of course, this isn't just limited to the UK. And as Brian said in his opening remarks, it's a really important area for ICMA and all its members when we discuss sustainability in all of our committees, bar none. So it's very pervasive. And therefore, this panel seeks to look at sustainability through the lens of a number of different constituents. We have issuer, investor, and bank experts across the EU and the Asia Pacific. And we're going to be exploring a number of different themes. So usually I would be saying to my left, but of course we can't do that on this platform. So I'm going to start with who I can see. And the first person I can see is Johanna Cobb, who is the Head of Responsible Investment at Zurich Insurance. Next, I have Lu Ying Gan, who is the Head of APAC Sustainable Bonds at HSBC. Next, I see Lars Iberholm, who's Head of Sustainable Banking at SEB. And last but not least, I see Matthew Reid, Head of Development Sustainable Finance at EDF, Électricité de France. So thank you all for making yourselves available on this panel today. I think everyone's still on mute, so just to remind you to come off. I think after 18 months or so, I think we're all pretty well used to the mute button by now. And one of the themes that we're going to touch upon first is the EU taxonomy, which pervades pretty much everything and is considered really to be the gold standard, although as it stands, a relatively small investment universe is actually 100% aligned with the taxonomy. And I'm going to start with Matthew and just ask Matthew, what are your thoughts on the EU taxonomy generally?
But just generally speaking, first of all, delighted to be here as a member of ICMA and the Green Bond Principles, Social Bond Principles, Sustainability Linked Bond, the principle. Generally speaking, as a corporate issuer, as a large provider of electric energy in the EU and around the world, we support the taxonomy. We think it's a really important tool in the climate transition and also to combat greenwashing, which I think greenwashing is something we'll probably get into a little bit today. And so the taxonomy is a really key tool in that. I think it's a tool for the transition. And as you mentioned, Katie, in its current form, it's sort of the gold standard. There's a relatively restricted investable universe, and we think it can be improved. It's particular to our point of view in our business, but we think that the emphasis on climate is really important, and that all climate-related technology should be included, and also just the complexity of implementation. Hopefully, it remains a useful tool as we figure out how to implement this. And we can talk about the different ways that translates to issuers, investors, and underwriters, but it ought not to become like a Rube Goldberg-like machine. And that's hopefully what we'll see as it rolls out. And then as it relates to other iterations of a taxonomy, whether it's a round taxonomy or social taxonomy, that remains to be seen. But as it stands, we support the taxonomy.
Excuse me, very good. Thanks, Matthew. And Johanna, if I can just turn to you with respect to reporting against the taxonomies, and Matthew's kind of highlighted, that there are challenges. How can issuers and investors prepare to disclose or report against it when it hasn't been finalized? I mean, is there any danger there of trying to second guess what the taxonomies will actually look like?
Yeah, and also from my side, good morning, everyone. Of course, right, working with something that is in progress, that comes with deadlines that I guess have, through the pandemic, work in progress and various legislative iterations, deviated a little bit from what they originally were planned to do, right? I mean, the taxonomy really is the bedrock in defining what is green, and we're starting with climate, and that will be added, and then social will come into play, but it founds the starting point for a variety of other regulatory movements and evolvements and updates within the EU Sustainable Finance Plan. So a very concrete example is the NFRD, the Non-Financial Reporting Directive, Directive meaning every EU country has interpreted it and broken it down in a different fashion. So EU companies and an insurance company, for example, just is counted like asset managers from next year on will actually need to already start reporting something like a green asset ratio. And then, additional data points. And doing that when the taxonomy is still in flux is pretty tricky. Now, of course, you have concrete alleviations that you first need to report only on sectors that are taxonomy eligible, and then over time move into truly taxonomy aligned. So that means really applying the thresholds and applying the do no significant harm. But that's a massive data undertaking, because if you're supposed to calculate that on an entire balance sheet that includes multiple asset classes, in which the taxonomy also doesn't really apply because it's built to apply to corporates, and then also some real estate and then some infrastructure, it's truly complex. It's a massive undertaking to try and do that in-house. So it will probably most investors and also issuers will probably try to work with data providers who are doing their very, very, very best to be as quickly and nimble as possible to make those products available. But it is a true challenge. So, and also a costly one, of course.
And of course, equally a very significant challenge for issuers when, obviously they've got to provide the information. Lu Ying, in Asia Pacific, obviously we're talking about EU taxonomies, but do the same challenges transcend Europe? And are you seeing the effects in Asia Pacific?
Yeah, definitely. Thank you, Katie. This is Lu Ying, and good morning and good afternoon to everyone. I think as Johannes correctly pointing out, I think there is not lack of challenging in applying the EU taxonomy threshold to from the investor side as well from the issuer side. And then as in Asia Pacific, looking after Asia Pacific issuers, but I think the EU taxonomy is still highly relevant for us because many of the Asian sustainable bonds are actually selling in the EU. So for example, we have ICBC on the screen today, and it is a 5 currency by 5 different bunches globally. So definitely we're expecting European investors could play a really important part in this type of Asian mega-size transaction. I think the work about mapping our Asian green project to EU taxonomy is on the way. It is done by many issuers internally, and then with the banks providing some technical support and guidance, etc. I think I would like to point out is that I think projects in Asia Pacific being in social or green, they are actually many of them are actually of high quality. If the reason why we are not able to release such an alignment with EU taxonomy, it may not necessarily be that we are not meeting those standards, but we are actually looking for a way to dig out the reliable and accurate data in order to make us justify our position as the EU taxonomy alignment or not. Then definitely would need lots of help from the market, from investors, from an international organization like ICMA. And then we also understand that many of them organizations like the green building certification bodies, they are also putting lots of work in mapping and applying those to not only in the EU context, but more in a global context. Yeah, so I think there are a lot to be done, but I think definitely we are on the way, and then we will get there.
Thank you, Yuling. So you and Johanna kind of both touched upon the fact that, a lot of resourcing to go into this, a lot of tooling up. Lars, do you have anything to add just on how ready the market is to align with the taxonomy?
Yeah, well, I think as Johanna mentioned, we are all sort of trying to prepare for the implementation and for the eligibility for next year, and trying to report on these things, and a lot of data is needed, and I think we will need to learn to work and deal with the taxonomy, because it's going to be a crucial part of all reporting. Just mentioned the NFDR, but also the Corporate Sustainability Reporting Directive. The taxonomy will be a crucial part here. Now, I think it's going to be a process. It's going to take a couple of years for the market to deal with this. But I do think when it's there and we see the first reporting, I do think a lot of eye openers will be created, and also a lot of new learnings. And also valuable contributions to capital markets and the transparency around sustainability in general.
Yeah, good. So just moving on to recent developments, the EU Green Bond Regulation and the EU Green Bond Standard to come out of that. We've got the Green Bond Principles, and they have obviously catalyzed a huge number of green bond issuances. And as far as we know, they work pretty well, and they have really become the de facto standard. So, Matthew, starting with you again this time, what do you think of the Green Bond Standard? Do you think it's needed, and do you think you will use it, and issuers generally will use it?
Yeah. So, Katie, I think you're referring here to the EU Green Bond Standard.
Yes, I am. Yes.
To be implemented over the coming years. I mean, look, as a corporate issuer, from our perspective, increased standardization of the market is ultimately helpful. And I think the idea with the EU GBS is that there's hopefully some simplification. And so, as I mentioned before, that's of interest to us. It's voluntary in nature. And so we've talked about, both Lars and Johanna touched on this, the time it's going to take to implement the taxonomy and the reporting related to it. And I think the same can be said of the EU GBS. For us, I don't think we see an urgency to update our framework just yet, but to progressively integrate some of the principles we see. And again, the taxonomy is the bedrock of all this. So to the extent there still are questions around both the form and the content of the taxonomy and its implementation, that's going to be a really key issue as well. So it's still a pretty fluid situation, but I think what's interesting about the EU GBS is that here you see, as you mentioned, Katie, that the importance of the green bond principles, which have become sort of the de facto standard for the market. And let's take a look, for example, at the recent EU green bond issuance. There, they made very clear reference to the green bond principles as sort of the baseline for, and it was an amazing issuance, the largest in history. Their order book was, I think, 11x. So part of the reason why, as a corporate issuer, we're deeply interested in participating in the principles is because it ultimately will end up getting integrated into these regulatory standards. And I think anyone who's watching the sustainable finance market will tell you right now that the trend is towards regulatory standardization. So one, is it needed? Yes, greater standardization is needed. Simplification is always good. Is it likely to become mandatory? I'm not entirely sure. And if it did, I think the market still needs, in any case, to retain a certain amount of flexibility to innovate. And so the way that the principles are iterative in nature, we saw this year with the most recent version of them, that there was an attempt to really bring them in, keep it in line with best market practice. And I think that's really the key principle, whether it's sort of market normalization and best practices like the principles or regulation.
Lars, what do you think of the proposed EU Green Bond Standard and its functionality and its perceived differences to for instance, the ICMA Green Bond Standard?
Yeah, I do think it's the requirements for aligning with the EU Green Bond Standard is higher than the principles as for now, and I guess that's a good thing, because then at least the market is developing and is taking a step forward. I think one of the main objectives with the EU Green Bond Standard was to take out, costs from the system, because then investors wouldn't need to investigate the greenness of the bond, because there would be sort of that check of the green bond has already been done. Hence the requirements for external verification and also for reporting and other sort of features in the EU Green Bond Standard should actually entail that investors should be investing in green bonds with more comfort. Now, I think the EU Green Bond Standard is still in its making, and we don't know where it's going to end up. It still sits with the council and needs to be, so to say, finalized and agreed. And there are some issues also in relation to living up to the standard, meaning that it might be very difficult. First of all, you need to adhere to the taxonomy. There's the do no significant harm. We are lacking to see who's going to verify your framework and the bonds, because these verifiers should be certified by the ICMA. So there's a lot of things still outstanding, and meaning that I think we will see at least a year or two before this standard will be sort of really adopted into the market. And I think we will need to wait for the taxonomy and wait for reporting and alignment with the taxonomy before issuers potentially will get the comfort in using the EU Green Bond standard. And back to also to Matthew's comments around, would it be mandatory? No, I don't think so. I would hope that when it's fully implemented and agreed, that issuers would actually find it useful to use it instead. And because I do think investors would see the EU Green Bond standard as the preferred standard to follow, potentially, if it is possible for issuers to use it, and therefore there will be sort of a natural market mechanisms that push from investors and the wish from issuers that actually potentially will make it instead of making it mandatory. That is my take. But a couple of years before we see it fully implemented. That's my take.
Okay. Thank you both. And just moving on to the emergence and pretty exponential rise of sustainability linked bonds, which I'm not going to say again, I'm going to call them SLBs, which is much easier. It's been really interesting to see how SLBs have really made the green market accessible to a huge number of issuers, some of whom you wouldn't have seen in the capital markets before. But Johanna, I'm interested to hear from your perspective, what makes a good SLB, and how can an issuer ensure that the SLB is actually creating the right incentives and attracting the right investors in terms of their greenness and their ambitiousness of targets, as opposed to just having the right economics? I mean, what is it that makes an SLB good and differentiates it from a normal bond?
A variety of things, of course, right? I mean, the SLB is fundamentally different from the use of proceeds family, the green, social, and sustainability bonds, in exactly that. You do not need to define the use of proceeds, right? So it has a different angle, and every issuer will use their preferred method. Some do have the projects which they really want to highlight, which is also good for investors, this transparency. And there's the other model where you say, it's not that much about how the money is spent. It's about how the entire entity moves. So you're looking at a company in transition, in a social transition, in a climate transition, and in transition on another environmental indicator. And I think that's what's interesting for the issuer, the freedom of spending the money how they want to make that progress. And that's also interesting for the investor. The tenor and when the KPI and the target is actually set might give additional comfort to the investor beyond a specific strategic cycle. So let's say the management board is there and the strategy runs in 3-year cycles, but the target is set for in 5 years or in 7 years or in 10 years. That might give additional comfort to the investor to say, the next management can come in and just throw everything overboard. They kind of need to stick to that because it has skin in the game. Which brings us back to the target setting, and it requires a certain materiality. If there is, general purpose use of the funding, and then the target is set on a tiny side note where sustainability performance is improved, but it's not material to the overall company, that's an issue, because then why would you fund it with a general purpose bond if it's only a small aspect? So the target really needs to be material for the company. It also needs to lie in the control of company, because achieving it is the entire point. It should be comparable and it should be reasonable, ambitious in really taking things forward. And that's where the advantage of an SLB really is.
And I think, Yuling, there's been quite a lot of interest in this product in the Asia Pacific market. Do you have any observations or comments about your market?
Yeah, definitely. I think not only in the Asia Pacific market, but I think globally we've seen the SLB volume has been growing dramatically. To give you a very recent, the latest data, so 2021 year to date, globally we have already seen over $16.5 billion equivalent of SLB issues just in this 10 months in 2021. Think about that. This is a new product. The first SLB only issue like last year this time in September, so it is only reaching its first anniversary, but it's actually reached the $16.5 billion is really impressive. But I think further to Johannes' view, I think investors and the market really asking for the robustness of the structure. We ask for the SLB to be structured in a way that the KPI is covering a majority of their business. The SPT, which is the target, is ambitious compared to business as usual. Otherwise, the issuer would need to pay up to some penalty, for example, some coupon step up. So this is actually putting money against what they say they would do, and that if they fail to do that, that would be economic consequence. So I think many investors are seeing that this is a very impactful product because it really put the action onto some economics, and some of the issuers actually really like this structure because they don't need to go through the hassle about earmarking green project, social project, etc. But I think one point that I really want to see the trend is that for the KPI and the SPT, there are actually quite good guidance in the market. For example, the SBTI, they are doing lots of work in promoting setting the number in a science base instead of just some random and business as usual scenario. And then they're rolling out their guidance to more difficult sectors like banking. For example, then it's actually quite difficult to do SLB in banking because the KPI, the SPT would really heavily linking to banks to measuring their carbon footprint. And then we are also seeing that many issuers, they are considering not only using the greenhouse gas emission, which is definitely the most robust, they are actually using greenhouse gas emission as one KPI and then couple with other KPI which is specific to the industry. For example, waste recycling, for example, in the social side, maybe the women in senior management. So we see that those type of core sector-like strategy would work quite well. So you highlight the key consideration everybody would have on the greenhouse gas as well as some of your sector specific. But again, I think we need to all work together to ensure this market develop in a healthy way, in a robust and credible way. And then I think investor would have quite a lot of power, have a quite a lot of say in this market. I hope, because then you have the choice about buying the credible one, the well-structured one, instead of the loosely maybe less credible ones. Yep. So we do hope the market would develop towards that direction.
Yeah. Just picking up your point about bank issuance. I mean, it's not really an easy one for banks to be able to circumvent the regulation, because our understanding in the EU is that the SLB current structures of coupon step-ups isn't compatible with the regulatory framework of banks. Have you do you see any kind of way around that in terms of structuring to make it compatible with bank regulation? And this is to you, Yuling, and to anybody else. Lars, maybe you've seen something similar emerging for banks.
Yeah, maybe let me start, and then
Sure.
I will let Lars to chime in when. And then I think this is a very good question, Katie. I think in the bank issuance side, there are quite a lot of discussion about the compatibility of the sustainability label versus the for example tier 182 label about capital securities. I think generally speaking, investors' view and market expectation is that it is for senior issuances for a bank shouldn't be a problem at all. So for example, we see SLBs in senior bond format by China Construction Bank and a German organization called Berlin HIP. So they receive very good market feedback. set aside the SLB challenging the bank facing, I think in terms of SLB's compatibility with sustainability in the senior format, that should not be a problem at all. I think there was some discussion about applying the sustainable bond label to capital securities. Then we also seen some of the Asian issuer also successfully doing that. For example, Axis Bank recently issue and sustainability 81. KEB Hana, which is a Korean organization, bank FIC, also issued one of them sustainability 81 bond last week. So we do think that the discussion would go on, but in the senior space, it is less question. In the regulatory and capital security space, we may need to pay a little bit more attention on the local regulation, the investor expectation, but we think that those labels are actually compatible with each other.
Okay, that's good to know. Lars, do you have anything to add on this, or Johanna, on SLBs or on bank issuance of SLBs?
Well, it's correct that we haven't seen a lot of SLBs issues from banks, and at least to my knowledge, the main what should I say, the main challenge here is the capital products and also the non-preferred and all sort of tier 1, tier 2, tier 3 transactions, and that is not doable in an SLB format. And that, of course, restricts the banks, because this is maybe where banks want to issue, and to a less extent as a senior unsecured note. And I guess this is where the challenge has been sort of created, and a way out of that is difficult to see. But of course, it's linked to having two optionalities in one bond might not be doable, and this is the challenge. Now, having said that, for banks to use the SLB product, I can't see that as a restriction as such, and it might even be a good product for banks, because you could actually set targets for the bank's footprint. It could also be on certain part of your balance sheet where you want to potentially either increase or reduce your impact, and that KPI or target could be a very good sort of communication tool to investors and stakeholders, saying, well, I take this responsibility and I issue a bond and put my hand on the plate and would be willing to potentially pay a higher coupon for achieving these targets. So I can't see banks would be able to use the product, and it might well be fitting well into some of the target setting that we are seeing banks will come out with. Also in the light of COP26, I think we will see banks coming out setting targets for their own footprint for their portfolio. However, I do think the use of proceeds product is the most common used by banks, and I do think also in covered bonds and real estate and other use of proceeds area where it's there are some low-hanging fruits, and this is where I think we will see the most green issuance from banks going forward.
Yeah, well, I mean, as you suggest, it is a journey, and actually, banks probably should be undertaking the journey as well. So it'll be interesting to see how that develops. Johanna, on the investor side, do you have any thoughts or anything to add to SLBs or to banks' use of GSS green products?
I just want to actually add on what Lars was saying, right? Because something that we hear a lot in the market is still a bit of a confusion on when to use the use of proceed instruments and SLBs, and if they could be compatible. And I think Lars just made an excellent example for that, right? Banks could be using both your own footprint, which is a lot smaller, but it's the only real emissions bank actually have that directly go into the atmosphere, right? Your own footprint, or the decision who you lend to, that is predestined for an SLB if the technical stuff gets sorted out. Whereas using the balance sheet to then pool projects that are green or social, and then refinance them with a larger issuance where the underlying projects wouldn't have been large enough to do it themselves, is the perfect use case for the use of proceeds. So that's a really good example how the two completely complementary in the same issue and could be used both at the same time, just to reiterate that.
Very good, thank you very much. So moving on, and we've had a question actually from the virtual audience about new taxonomies, etc. And we've already sort of stressed in this panel that the market needs to develop in a healthy way, and we're now seeing new developments elsewhere, such as green commercial paper programs, possibly. Well, we've got green loans, looking at greening derivatives. I mean, issuers are now looking at asking some of their banks to do something with their deposits, greening their deposits. And with COP26 coming up, and China has made a net zero pledge backed by a serious environmental policy, and the European Commission is accelerating work on climate change and finance. We're seeing a lot of activity. We're seeing green taxonomies emerge, such as the UK's, which came up right yesterday. We're seeing green bond standards emerge, like the EU one, and we see quite a few of those in Asia Pacific as well. With such a lot going on, and I think we've already stressed that standardization is good, but with such a lot going on, is there a risk that there's a divergence of standards, that it will lead to confusion between EU, UK, Asia Pacific and the US, and that could actually stifle the market rather than encouraging it to flourish? So a big question, and Matthew, I'm going to start with you if you wouldn't mind.
Yeah, I think candidly, there is a risk of getting things confused. And look, you already see this in terms of corporate ESG ratings, just the divergence in that area right now, which is, by the way, another project that EU is kind of working on right now. But the diversity of ratings methodologies, and then just some studies that have been conducted on how little they're correlated. So again, divergence, and I've touched on this earlier, is it's a challenge. I think what we've seen is a trend towards wanting to base, and so Katie, you mentioned the UK, base the emerging taxonomies based on what's already been done. And so here we've seen most taxonomies that are coming out in some form wanting to build upon what's been developed in the EU, and the UK said really clearly that's their intention, with potentially a few different exceptions. But the challenge, of course, becomes for issuers to the extent that other regulatory tools, such as Lars and I have talked about, so for example, a green bond standard in a given market, are based upon that taxonomy. If all of a sudden you have overlapping and competing definitions of what a green bond is, then it gets very challenging as an issuer. So the hope is that things sort of converge in a meaningful way. And I think one of the things we started talking about, this overhanging it all, is the fight against greenwashing. And how do you make sure that the standards in place are usable, but also rigorous enough to convince market players that the risk of greenwashing is relatively low. So yes, diversification is a challenge. In some cases, it gives rise to innovation. But overall, if the focus is on avoiding greenwashing and making sure that sustainable finance is meaningful, I think it's heading in the right direction.
Okay, that's interesting. And Liu Ying, I know you mentioned previously that a lot of different countries in Asia Pacific have their own green bonds standards and taxonomies, etc. How's that working? How is it working in Asia Pacific? How easy is it to comply, and how easy is it to understand?
Yeah, I think this is again a very good question, Katie. I think there are many discussion on the divergence about the taxonomy, especially between the EU and Asia Pacific. I think I would say that there are some differences between that, but I would also want to point out that I would think 95% of our definition and understanding on green and social is completely aligned with the ICMA green bond principle, social bond principle, etc., as well as international investor expectation. So when we structure sustainable bond in Asia Pacific, we reference to the international standard. We would like to bring the international investor expectation to our issuer instead of driving them to only focus on the the local taxonomy. But that said, we are aware that China has its own green bond catalog. Singapore is starting to develop a taxonomy that would be applied to its own as well as the ASEAN country. So I think in terms of green, I think we may have little disagreement with each other to what can consider green or not, maybe on some very technical points. But I think in the transition area, we do see quite a lot of discussion in that sense, mainly because I think there are many local markets, especially in the emerging side of the world, would actually need a lot more consideration on how to justify orderly transition. So I think there is some new saying, it's like transition with justice, because I think we not only need to consider the climate impact of our activity, but also the socioeconomic impacts to ensure that the local community have affordable energy, for example, instead of only focusing on renewable, which would be much more expensive in the Asia Pacific than fossil fuel. So I think there are actually many considerations to go in. Then I think in that situation, a localized taxonomy would be more needed in order to cater for the local situation, as well as for the better convergence with international.
Excuse me. And from an investment point of view, Johanna, and you mentioned earlier about your benchmarking and comparability and the importance of that. When you have lots of different standards, although they're generally pretty well aligned, is it difficult to make the investment assessments when you're looking at different standards?
There's a difference between a difference in standard and in content, right? I think about it in a Lego approach. If there is something like a taxonomy, it would be very helpful if it follows the same underlying logic. Various taxonomies that follow completely different logics will really, really make things complex. However, if they all function the same, but then we have different regional thresholds to say what is green enough or what is needed, right? I had this wonderful example listening to someone speaking about the ASEAN taxonomy, and making this example say, look, the EU taxonomy, when we speak about electricity and energy, it's fixed on the idea that you all have central heating because it's cold and how you need to switch this. In Asia Pacific or in ASEAN, we don't have central heating. It's hot and it's humid, and that means air conditioning, which means electricity and how this is produced, and diesel generators. It's a completely different starting point, a completely different project. And that makes sense, right? We need to get trained to thinking locally where we start and where we're going. So that regional footprint, that nuance and variety and comparability is completely justified and actually provides benefits if the way in which we think about it is standardized, right? And if then the GBP pillars and the framework is standardized and the logic is standardized. So standardization in logic, please, but then some nuance in how to fill it with content can actually be beneficial.
Okay, good. That absolutely makes sense. And I tell you, we're starting to switch on the central heating now in the UK. It's a lot of the world leaders will find next week when they emerge on rainy Glasgow. So Matthew mentioned earlier there the G word, greenwashing, and Lars, I just wondered if you had any thoughts about, is there a collective responsibility on the market to ensure there's discipline and there's integrity on the green market as a whole, in order to minimize greenwashing, and how can it be managed? How can the risks be managed?
I do think we do have a responsibility, and now we are talking about taxonomies and different taxonomies in different jurisdictions, but we have one common goal, and that is to basically to adhere to the Paris Agreement. And I think all of these taxonomies globally needs to align on that point. Now you can have then differences in the different jurisdictions and also different approaches, etc. But I think that is the main objective with a lot of the sustainable finance that we do today. And here I do think we have a responsibility to make sure that the sustainable finance, that goes for green bonds, but also green loans, and especially also the sustainability-linked loans, is not just business as usual. And we are not just relabeling things that we are just doing anyway, sort of business as usual. But now we just put another label on, and then all of a sudden it's all good. No, it's not. Because I think the sustainable finance market is growing big time, and during September we crossed the $1 trillion issuance, including loans, bonds, etc. For this year, and I really hope that we now also start to see investments and progress, and all these targets being set by companies and others, that they actually align with the long-term objectives and goals, and that is to keep the global warming below 2 degrees and preferable 1.5 degrees, and that I do think we have all the responsibility to make sure that actually the targets, the assets that we are financing, the activities that we are outlining, it's actually following that goal, because this is very, very important. And here, many new participants are coming into sustainable finance, and we need all of us to make sure that we are not sort of taking any shortcuts and just relabeling activities that are not aligned with the long-term goals. So a common responsibility, no doubt.
Yes, and Matthew, as an issuer, and obviously you are at the coalface of any damage that would come about with respect to greenwashing. Is it something that you manage? You spend a lot of time on internally to make sure that it's never going to actually materialize?
Yeah,
how important is it for an issuer?
Yeah, well, look, I think this is like a really critical issue to think about right now for the participants in this forum. There's Lars mentioned the growth in the market this year, which has been amazing, but there's there's an upswell right now, or at least a debate around whether sustainable finance is actually useful and productive in terms of meeting the Paris Agreement. So in terms of greenwashing, in terms of making sure this all works, it's just an absolutely critical issue right now. And I think we all bear some responsibility to answer your question. Yes, all market participants do need to work together. And so convening organizations like ICMA are really important in that regard. And so I really like the way Johanna framed this of adhering to certain, in terms of standardization, a standardization of principles, principles being sort of like the basic values essentially, and then adapting. And so, and then we've talked about the diversity of tools that exist now. It started as use of proceeds bonds. Now we've got the SLBs. Katie, you mentioned green CP, derivatives, and so forth. These all need to be based on certain principles. So what does that look like concretely for us? It does look like working with different market participants. So EDF right now, just to use a very quick, concrete example, we've stuck with a purely use of proceeds approach for reasons that are specific to our situation. We tend to have enough eligible CapEx, makes a lot of sense. We think it's what our investors want to see. But we know all that because of the dialogue we've tried to have with our investors and underwriters. And so this year, when we published our social bond framework, that was done in consultation with our investors and underwriters and looking at our corporate strategy, making sure that was consistent and where we saw chances to invest. But then we also we made sure the framework was aligned with the principles. It's unusual for a corporate issuer to issue a social bond, so we had to be pretty careful about that. But then we left enough room for us to have dialogue, especially with our investors, to know how do we make sure that this is actually driving impact in a way that's meaningful to you and to the target populations in the framework. And that dialogue was really valuable, and it's helped us move towards impact reporting that's going to be really meaningful. So I think that's a really good concrete example of the ways all the market participants, at least for us, can really try and contribute to something that's meaningful.
Okay, thank you very much. Now, I'm being shifted along because actually we have run out of time. We could have carried on quite a bit longer there, especially on this very interesting topic of greenwashing and market integrity, etc. But I'm afraid we'll have to wrap it up now. But I would just like to thank all of you for your extremely valuable inputs and insights. So thanks to Johanna, to Lu Ying, to Lars, and to Matthew. And with that, I'm going to hand back to Brian to continue with the agenda. Thanks.
Hello. I think, Katie, thank you to you and the panel. That was a really interesting discussion. I think it brings out a number of points. I mean, firstly, the complexity and complication of applying and implementing the taxonomy in different regions is extremely challenging. Also, I think, as Liu Ying mentioned, it has global implications and impact across the board when we're applying processes in different regions. And I think that word standardization again comes to the fore in terms of hopefully from a COP26 perspective, but also looking at things like the common ground taxonomy under the IPSF umbrella. I think using that really to create standardization while at the same time enabling the science and technical standards probably in different regions where there's a different pace of transition taking place to manifest themselves. Obviously as well how the green bond standards and the green bond principles sit alongside, and the evolution of that process is going to be very interesting to watch. So I think a number of very interesting and good topics there. With that, I will now move on to welcome and introduce Dan Kuhnel from Euroclear, who will give us a short presentation on the new issue closing process changes for syndicated deals within the ICSDs. So Dan, over to you.
Very good. Thank you, Brian. Good morning, good afternoon, everyone. First, I'd like to pass my compliments to the previous panelists as well for a very interesting session. Also, a big thank you to the ICMA team for the invitation to provide a short update on behalf of both ICSDs, so both Euroclear and Clearstream, on this new market initiative and what it entails. I'd like to add that this has been a very collaborative effort across the global financial industry, and this has been taking place over the course of many months. And I honestly believe that this is an excellent illustration of how the various primary market actors can work together in unison and towards a common goal to improve the new issue process flows. So to initiate, the main drivers behind this initiative were, number one, first, to reduce the number of intermediaries in the payment flow chain to the issuer, and thus making the closing flows much more efficient. And number two was also to reduce the timing associated with the lead manager's credit consumption. So the fact that the lead managers have to fund every new issue that's a syndicated deal, and linked to the market drive towards accelerated issuance timings, there's a growing requirement for this to be made realistic within the international capital markets. Just to note, please note that this model does not mean that there are major changes to the existing syndicated closing flows that the market actors have been using for many, many years. This should not be considered a major change for issuers, investment banks, or the legal counsels involved. It is simply a case of trying to build more efficiency into the market flows. So what is in scope of the new model? So it is limited to syndicated new issues against payment, which are issued in the ICSD, so Euroclear and Clearstream, issued through the account of a settlement manager or lead manager, and as a result of being issued through the ICSD, deposited with a designated common depository or common safekeeper. What is out of scope? Free of payment syndicated distributions, they do occur, so they are not in scope of this initiative. Non-syndicated deals, which are done through the account of an IPA, or so issuing and paying agent, and of course new issues which are issued through a domestic CSD. Next slide, please, Leanne. Thank you. So the ICSDs have been working with the market to design a new model to make the process flow of syndicated deal closings more efficient, more secure, and of course to meet the benefit that of the whole market. And to achieve the objectives, the ICSDs will leverage a new legal concept that will be introduced. It's called a commissioner, and I add it is fully compliant under both Belgian and Luxembourg law, so the two laws that the ICSDs operate under. So each ICSD will act as a commissioner for their lead manager clients. So a new commissioner account will be opened in the name of each ICSD, but for each lead manager. And this will become the new distribution account to be used for a new syndicated deal. So the account will be a new distribution account. The ICSD will receive and distribute the new issue on behalf of the lead manager, but for the benefit of the issuer. So there's a third-party beneficiary clause linked into this. And that links into the red text. So there are supplementary terms and conditions which have been developed and agreed at a market level, largely with the assistance of the ICMA to have these documents prepared. And these supplementary terms will govern the use of the new account, including the elements around the third-party beneficiary clause. Now, linked to this, the ICSDs, we just seek to encourage that the transaction steps that the various parties are involved in the conditions precedent to closing, leading up to the actual distribution, in order to keep the concept of accelerated issuance, we seek to just remind everyone to try to complete these steps as early as possible, including anything that can be done in a pre-green light process to ensure that the timeliness of these deals remains optimal. Next slide, please. So the new commissioner account, what does it allow? So the initial deposit of the new security will be into a commissioner account, which will replace the existing syndicated distribution account. And what it removes is the need for the irrevocable commitment to pay. So behind the scenes, for each syndicated transaction that is being done on a DVP basis, today, once the funding is in place within the lead manager's account, we as the ICSDs will issue an irrevocable commitment to pay to the common depository to execute the payment to the borrower. And so by removing this payment flow step, it actually reduces the amount of time that the lead manager needs to put up the funding requirements, either cash or collateral, through that process. So there's a clear reduction in credit usage, which we call credit compression. The second is the DVP settlement between the lead manager and the syndicate members, but this also applies in the case of pot deals. So the lead manager selling to their own trading account. And the DVP settlement now will take place on the books of the ICSDs, and the payment will be made directly from the commissioner account. And so lastly, to replace the current flows, instead of now running the payment, which is today's scenario, running the payment through the common depository to the borrower, the payment now will be done in accordance with the instructions provided from the lead manager to pay directly from the commissioner account to the account of the borrower. So in case you're not aware, yesterday, the ICMA published an informational paper regarding the new model, and it includes suggested deal documentation language. So I was asked to remind that if there are any questions on the content of this document, these should be directed to the ICMA. And in conclusion, I'm aware there is some talk in the market that the targeted launch date, which was planned as 13th December of 2021, may be moved. So the ICSDs have actively been assessing the overall market readiness of this initiative, and I can confirm we have assessed that there are sufficient reasons to look at a short delay to the launch. So please take note that the new effective date is now planned for the 14th of March, 2022. The ICSDs in this decision-making process have taken into consideration the potential challenges that this timing move could create due to high market volumes during the March season. And therefore, we seek to recommend that the launch date is considered when deals are being prepared around that particular weekend in March. Lastly, the ICSDs are there's a joint announcement about the new date that will be released shortly after this event concludes. And lastly, as we don't have time for a Q&A session, if there are any questions on this initiative, these should be directed to your usual business contacts within the ICSDs that you deal with. And lastly, thank you very much for the opportunity to speak on this topic.
Dan, that's great. Many thanks for that update on this very important technical and process change. I think that's of great value to everybody. Now I'll pass on to Charlotte Bellamy from ICMA to host and introduce our next panel on the recent developments affecting the primary bond markets. Charlotte, over to you.
Thank you very much. Thanks, Brian, and hello, everybody. So, as Brian mentioned, I'm Charlotte Bellamy. I'm a Senior Director in ICMA's Primary Markets team. I'm delighted to be moderating our panel today on recent developments affecting primary markets. It's been a busy time on a number of fronts, and we have a brilliant panel lined up today representing most of ICMA's core primary markets constituencies. So perhaps I can just ask each of the panelists to briefly introduce themselves. So I'll just run down my list here. Let's perhaps start with Frank.
Hello, everyone. My name is Frank Engels. I'm ICMA board member, and in my normal life, I'm heading the global fixed income team at DWS in Frankfurt, Germany.
Great, thank you. David?
Morning, everybody. As David Hopkins, I'm head of debt capital markets legal team at NatWest Markets. I'm also the chair of the ICMA Legal and Documentation Committee.
Perfect. Mark?
Hi, everybody. I'm Mark Lewell. I run the Asian and European syndicate business at JP Morgan, and I'm also co-chair of the PMPC and an ICMA board member.
Great, thank you. Liang?
Hi, good afternoon and good morning, everyone. Thanks to ICMA for organizing the forum today. My name is Liang. I am the head of DCM and Bond Syndicate APAC for BNP Paribas. I'm based in Singapore. I also co-chair the Asia Bond Syndicate Forum for ICMA here in Asia. My pleasure to join the panel today.
Thank you. And Richard?
So good morning, good afternoon, everybody. Thanks for having me in this panel. As Charlotte said, I'm Richard Teichmeister. I'm heading here at the European Investment Bank's funding team, a unit which deals with new products and special transactions. So in that function, I'm not so much following the mainstream market developments, but more focusing on things such as, in the past, risk-free rates, most recently, a blockchain transaction.
Super. Thank you very much, everybody. So we will be looking to spend the next 45 minutes or so giving a broad overview of some of the key recent developments in primary bond markets. Now, in preparing for this panel, we of course identified some of the key developments in terms of sustainable finance and technology. But of course, they are being covered by other sessions in this primary market forum. So we won't be sort of delving into those in any detail, but they may be brought up nevertheless, given that they are so topical. Another point just to mention up front is that ICMA is incredibly busy in terms of our efforts and focus on LIBOR transition. Previously, that was a very important topic for primary markets. And very significant progress was made in terms of the transition away from LIBOR towards alternative risk-free rates. But now our focus is really on the legacy book. So again, we won't be sort of raising that on this panel today. Okay, so with that said, let's take a look at our first topic for today, which is recent primary market dynamics. So I think we've mentioned now a few times it's been sort of a busy time overall for primary markets. But perhaps, Mark, you could start off by giving us a bit more colour on that. And in particular, if you could comment on this from your EMEA perspective, that would be great. Thanks.
Thanks, Charlotte. Well, I mean, I think everyone watching today is well aware that it's been an incredibly busy market. It's easy for us to take for granted, I think, the positive and sort of healthy primary market that we've seen in the post-COVID period. But obviously there was that 4-week period when it really felt like we may be entering another very challenging crisis situation in the bond markets, as well as from a personal and health perspective. Clearly, the central bank support globally was a key factor in ensuring the very swift recovery of the markets in general, but in particular the primary markets, and that has been the dominant theme, if you like, over that intervening 15 months. We're now getting to a point where we're probably seeing a slightly different dominant theme, which is that in certain market segments, at least, inflation and the spectre of the reversal of central bank support is going to become, or is already becoming, but is going to become the key topic of debate. That is more of a factor in certain currencies than others. In dollars, obviously, there's been more treasury volatility throughout the year. In sterling, gilt volatility is having an impact as people anticipate potential Bank of England rate hikes. In Europe, really, we've seen some move in rates, but the market has remained incredibly open and open for business across a variety of products over the course of this year. As we look ahead to next year, I think the key point that will impact the primary markets will be the reversal of those central bank supports, and what happens when the Fed begins tapering, what happens as the ECB lays out a timeline for damping down and eventually removing some of the purchase program supports, and how robust the primary market can be standing on its own 2 feet, if you like, and in a slightly changed rate environment. What I would say is that this is where I think the ICMA commercial comes in. I think the ICMA as a forum for participants on all sides, issuers, investors, and dealers to come together has been incredibly helpful in supporting the market through what was a challenging work environment, in particular last year. And as we've got into this year, I think as we'll talk a little bit later on some of the topics for change going forward. I think it's really important that we keep communicating as a sort of market community across all facets of the market to make sure that we get the best outcomes for investors and issuers alike.
Great, thanks. Okay, so how about the Asia Pacific perspective? Does what Mark just said chime with you, Liang?
Yeah, sure. I think thanks for the question, Charlotte. I think Mark summarized very well some of the trends we saw from global perspective. In Asia, I would say market continue to grow. If we look at the volume for Asia ex-Japan G3 currency, in terms of volume, we're up year on year with over $300 billion now, and last year was a record year. Just to add a few observations from Asia perspective that is perhaps more localized. First, on credit market overall, I think market overall is benign globally, but we had a few challenging situations in Asia, particularly in China. Huarong Asset Management for one in IG space, and Evergrande and a few others in the high yield space. These events have obviously triggered volatility in the credit market, and the investor will have to navigate through that. We saw Asia high yield default rate has gone up, particularly in the property sector, as a result of the tighter government policy. But on the other hand, how the government has responded, the tolerance for letting troubled companies go under, i.e. a more market-oriented approach, could also help to build a bigger and healthy bond market as well. The second observation, I guess, is US-China relationship. This topic has been going on for a while, and it obviously has an impact on the global credit market. But one of the impacts we see on the bond market is the US executive order, which would require most of the market participants to follow certain sales and trading guidelines. The other one came in recently is the anti-monopolistic measures, which we saw tighter regulatory requirement on certain sectors in China, including tech, education, etc. These events also has an impact on these sectors. Another important aspect is ESG. I know we talk about quite extensively in the previous panel, but I think from the primary market perspective, everybody is talking about this topic. I would like to add is that we have seen in the past Europe pretty much lead the way on ESG, but we're certainly seeing strong catch up from the APAC region. Now it's hard to find a meeting with issuer or investors without mentioning ESG. And almost every transaction with market, whether it's with ESG label or not, we do have questions from the investor side for ESG related question, whether it's on bond level or issuer level. So I would say the awareness in APAC is definitely increasing, and we have large number of issuers this year issuing ESG bond for the first time. And a few others, including the format of how primary deals are done. I mean, if physical roadshow is no longer there, most of the deal roadshow or non-deal roadshow investor work are done virtually. These are the changes we've seen from the impact from COVID. But overall, I would say APAC region continue to grow and develop despite of the challenges we face. APAC region do have our own characteristics, which is relevant given more and more global players are looking at APAC and becoming more interesting for all the global players.
Great, thank you. That's a really, really helpful and broad-ranging overview. Thank you. Frank, listening to that from your perspective as an investor, what would you comment or react in terms of recent market dynamics?
Yeah, thanks. Thanks to everyone. I can obviously chip in the view of an investor, and we are obviously concerned with a few developments that seem to be getting a bit unhealthy, given what Mark mentioned, that we are in a changing interest rate or yield environment, and that we obviously have to face markets standing on their own feet again, given that central banks are withdrawing or are about to think about withdrawing support. Let's put it a bit more cautiously. In a sense, so we have seen quite large increase in volumes. We have seen quite large increase in duration, so duration extension by issuers taking advantage of this super low yield environment and the very flat curves. And thirdly, on top of it, we've seen a deterioration of the covenant quality for securities issued, meaning that the risks that investors had to take over in sort of participating in these issues have increased for the investor side rather than the issuer. So in a sense, it has been a seller's market, so to speak. And that is true for the high yield segments. That's true for the investment grade segments and credit markets in Europe. It's also true for the emerging market debt market, specifically the sovereign market, where several regions, specifically the Eastern, Middle East, but also African region, had new issuers joining the benchmarks. And then we obviously had the supranational, the SSA market segment in Europe expanding quite rapidly, given the sort of debut issuance by the European Commission. The SURE and the Next Generation EU, issues had been record high in terms of volumes, but also in terms of bid to cover ratio. So tremendous demand for these type of bonds, the social bond and the E related, so the green bonds issued by the Commission. But also, so on top of that, we had obviously the commercial paper market being closely looked at, because that was probably the market segment that had some turmoil in March 2020 when the pandemic really hit. We all recall that, and ICMA and others have looked at this market very carefully, and the ICMA has issued a white paper on this to see how we can get to a more harmonized commercial paper and certificate of deposit market segment going forward. I think that's very, very important, given that the market is pretty fragmented still into national jurisdictions and market segments, and we need to come to a point where we have a truly sort of capital market union type CP and CD market segment going forward. So in a sense, what Mark touched upon is investors are getting nervous. They have taken quite a lot of duration on their books, given that duration extension was sort of exerted by almost every issuer out there. And that type of duration has been taken out to some extent by central banks who have taken that on their balance sheet. So there was duration extension and duration extraction. So the market had an almost perfect balance. Now that balance might need to be reviewed given the fact that the ECB and others are going to taper at some point or going to stop purchasing at all. So in that sense, at the time when yields and inflation risk are rising, then obviously issuers are keen to issue even longer dated debt because they want to lock in the still relatively low yields, in markets. If at the same time then central banks withdraw some of their support, it could be getting quite ugly in terms of technical situation at the longer end of the bond market segment. So that needs to be carefully watched going forward. All in all, a very healthy development in terms of size, in terms of new market participants coming on, new benchmarks being created. Think about the 100-year Austrian bond that was sold very successfully. Other sort of really, impressing debut issuance out there. But again, quality has deteriorated in terms of governance, specifically on the high yield side. And we should also not forget that governments are probably about to withdraw their sort of balance sheet support for the non-financial commercial sector, and therefore for some of the issuers, so that also the issuers have to stand on their own feet again commercially. So probably the credit quality will be eyed more skeptically or more sort of diligently from investor side going forward into next year. That's sort of my sort of 5 minutes on this. Thank you.
Thank you, Frank. Really interesting. And I think all of those comments from Mark, Liang and Frank give us a really good background in terms of not only what we've seen, but also what we might expect to see sort of in the months ahead. And there's clearly a lot to watch out for. So with that background set, perhaps we can move on to our next topic, which was a very important development that took place earlier this year for the bond market generally. And that was the issuance of EIB's blockchain bond. So Richard, you were very closely involved in this from EIB's perspective. Perhaps you can just start by telling us what EIB's blockchain was or is, and what was different or new about it compared with other distributed ledger technology issuances that had gone before it.
Yeah, of course, Charlotte. Thank you. Let me start with saying what was different. So when we started to look and to develop the idea, that was now 2 years ago, we were looking around what already existed at the time. And there were a number of transactions already out there. I think the first one I can remember at the moment was already done in 2017. And there are plenty of others. But what we found was it was a bit like many people trying to build a car, but some people are focusing on the brakes and others are focusing on the steering wheel. But nobody tried to bring all the elements that are characteristic for a car, bringing it all together. And for our transactions, that meant we wanted to examine how close could we get with a blockchain transaction to the car. In our example is the traditional EIB off-chain benchmark transaction, which would be characterized by the features such as it should be meaningful in amount and maturity. It should be lead managed by a group of banks, and not just by one lead manager. It should be targeted to an unlimited number of outside investors, so not an intra-group transaction. It should ideally be tradable in secondary markets, and it should be publicly listed. So these were the target features, and we were able to tick most, but not all of the boxes for reasons we can probably talk later. So what is the blockchain bond that we launched? It was launched at the end of April this year. It is a euro 100 million 2-year zero coupon transactions. When we presented this to the market, we had to explain very often, no, it's not denominated in a cryptocurrency such as Bitcoin or anything else. No, it's a euro transaction. It's denominated in euro, and we developed it. We brought it to the market together with 3 banks: Goldman Sachs, Santander, and Societe Generale, and basically the additional element that we didn't expect, but we were hard working on it, was a settlement between the lead managers in a representation of a central bank digital currency, which was provided by the Banque de France.
Okay, thank you. And so were there challenges in bringing this to market? And if so, can you outline those?
Yeah, of course there were challenges. There are always challenges, and they were quite numerous. I think as I said, we started the whole preparation process, took about 18 months, and we started at the end of 2019, and already the first obstacle, the first difficulty consisted in identifying the banks that would, on the one hand side, have an interest to work with us, but also have relevant expertise. And it was in this context that the other transactions that had already existed provided a very useful basis to identify the banks and to develop the necessary processes, but also product features together with the banks. So let me look at the technical side. So we were looking for a solution that would be relatively easy for investors to implement and to participate in the transaction. As a consequence of that, we decided that we would issue the transaction on a public blockchain, Ethereum in our case, because we were expecting that Ethereum and the public blockchain would probably already be known to the investors, while had we chosen a private blockchain, probably we would have had to explain to investors the details and the nature of the private blockchain. And at the same time, why Ethereum? Ethereum was relatively well already developed with respect to the smart contract features. So the technical development needs, to the extent it would be needed, could be relatively easy done compared to other solutions that would have possible. Having said that, that doesn't mean that for future projects we would definitely again insist on a public blockchain. I mean, we will continue to evaluate all options, and a private blockchain is certainly also, or private blockchains in general, are certainly also on our radar screens. And then on the legal side, we had to identify a jurisdiction that would recognize the concept of a bond issuance on a blockchain, because very often or traditionally, the existence of a physical signed note that represents the bond and the investor's claim for reimbursement of principal is a precondition for issuance. And it was then in early 2020 when we had to make that choice. We had to exclude Luxembourg legislation. That would be our normal jurisdiction for euro transactions, because Luxembourg would not allow for it, but France did. And that's why we then decided that we would issue under French law, which obviously had also its setbacks. It was not possible to structure it as a publicly listed transaction. It is a private placement, which obviously didn't facilitate the distribution to investors. Now coming to the last obstacles, investor work that had to be done. The initial interest was enormous, but then we had to realize many investors that said, we are waiting for something like this. When it then came to participate in the transaction, many had to admit that they would not be ready for the transaction because they would require internal approvals or for other technical reasons. So I think that's what we will need to focus in the future for follow-up projects.
Okay, thank you. Frank, as an investor, do you have any views on, I guess, the use of this technology and EIB's bond more generally?
Yeah, first of all, let me extend gratitude to the EIB for being so innovative, and I do think it's very important that a reputed issuer like the EIB started off, approaching the market with this, and I do think it was very smartly organized and set up. And from our point of view, we obviously, investors had challenges. I can talk about my experience at my previous employer, where we looked at this carefully. And first of all, it needs senior, if not executive board management support for this, because it's clear a sort of new digital bond like the one issued by EIB creates all sorts of manual procedures, first of all. Even though it's a digital bond and it's supposed to settle atomically, it takes a lot of manual efforts to get this through the system. So first of all, one needs to check whether it's a new investment, a new product process that needs to be started. And thankfully, given the structure of the bond, we realized we could just deal with it as if it was a normal sort of physical or normal security issued by the EIB. So that was very helpful. So you would not need necessarily to start a new product approval process. Then you obviously need to find an entity, a fund basically, some vehicle to be, at the receiving end of that thing. So it needed to be a very flexible fund in terms of its product prospect to be able to accommodating this security. Then obviously there's not yet a secondary market for this. There's a secondary market for normal EIB bonds, but not for digital bonds. So clearly, in terms of mark price detection, in terms of fair value pricing and all that, they have to be established at the beginning, at least, manual processes. That were sort of the first impediments we're facing. And then obviously, the most important thing is that you have a custodian who's able to have a key for the wallet. So in a sense, Ethereum was very helpful in that regard, but clearly along the value chain of, front office, middle office, back office, custodian, at the end of the chain. So the back office and custodianship, they are the key issues from my point of view, from an investor point of view, because you need to have someone who can, regularly, ideally automatically check the wallet and enter the wallet. So sort of the existence of a key at the custodian for that type of wallet is of utmost importance going forward. We had roughly 60 people alongside, including legal. I forgot about legal, obviously. We had to check all this from a legal point of view and from a compliance point of view. We had roughly 60 people working on that, sort of extra efforts. But it was worthwhile because you realize then, what the future of digital bonds mean to you from an investor's point of view in terms of the entire value chain from the trading desk up to the custodian. And I can only repeat myself in saying the EIB did a tremendous job in preparing for this. And so we were able to do it in a relatively short period of time, but it needed to have senior management support to open all the doors that were initially closed. So in a nutshell, good development. I'm looking forward to more of that going forward. And clearly, I do think governmental or supranational agencies or issuers are best suited to open up this market and to be as innovative as the EIB has been with this.
Great, thank you, Frank, and to Richard, and indeed congratulations to EIB. And I think a lot of what you said will be useful for our audience today. Frank, you mentioned you forgot legal. We can't possibly forget legal here at ICMA. And our next topic is going to bring in David Hopkins, head of DCM Legal at NatWest Markets. And that's Brexit, which for most of us based in Europe and particularly in the UK is something that was relatively significant and has been for a number of years. But at the end of last year, clearly we had a quite significant milestone in that it was the end of the transition period. So David, how did that all go from a sort of legal perspective?
Well, thanks, Charlotte. Look, I think the great advantage we had as far as Brexit was concerned was, the amount of time we had to plan in advance. In the end, there really was no cliff edge, and we were ready. Effectively, it was 2 years in the making. So I think the headline is that it was a very smooth transition in January 2021, and the move from pre to post Brexit happened really without a hiccup. The market saw no disruption or interruption, certainly none caused on the legal point of view. And I think there were two main factors for that. First, those banks, predominantly the UK banks, of course, who needed to ensure that their EU operations were set up through subsidiaries or new entities located and regulated in the EU, had already put those plans in place long before Brexit Day. Many were fully operational and carrying out a bond business already in 2019, certainly by 2020. And so clients and counterparties were fully aware, KYC was complete, all processes were up and running. And so really there were no surprises in January, just the continued implementation of an already functioning operating model. So I think in this case, the various delays and procrastination on the Brexit front actually played into our hands to allow us to be ready.
Great.
Shall I go on to talk about some of the actual legal changes we saw? So I think, again, we were able to make use of that additional time we were given, if you like. Obviously, there were a few technical changes that accompanied Brexit, but also they were well flagged, and we were able to talk about these, of course, in Legal and Documentation Committee, and gives ourselves time for that debate. So there were various things such as, in the areas of product governance, assessing the different requirements and language needed for EU and UK manufacturers, the various EEA and the new UK selling restrictions. They were already drafted ahead of time. We were able to have the debate in LDC, as I've mentioned, and basically, the new templates for final terms for prospectuses were there and ready to go. And, ICMA had, through LDC, as I mentioned, and with the great help of the law firms who assisted with the debate and with the drafting, ensured that all the underwriting banks were agreed on new language, and this was an enormous help to the smooth running of the market. So I think, thanks there to the ICMA for that, but also to I think, as Brian said at the beginning, particularly to Alan Overy, Clifford Chance and Linklaters, who all contributed to the drafting and the readiness there for those legends and disclaimers, etc. Again, a great support to the market. And we were also helped, Charlotte, by the way that the EU Withdrawal Act worked, and the fact that the prospectus regulation was incorporated into UK law was a big help. And one last final thing on this to mention, I think, was, did we see any changes on use of English law, for example? I'd say that over in recent years, yes, we have seen an increasing trend perhaps for issuers and counterparties to request domestic law in contracts. But I would say that English law certainly remains very much alive and very widely used in the bond markets. So I wouldn't say any material change particularly as a result of Brexit happening on that. So overall, I would say a smooth transition, a smooth post-Brexit period, largely down to the long lead time and the hard work of everybody to get ready.
Great, thank you. And just briefly, Mark, does that chime with you from a syndicate perspective as well?
Sure. I mean, I think totally agree with David that on the one hand, the markets glided on sort of calmly and serenely like a swan, but of course under the water, the prep work that all the law firms did, that ICMA did, that the banks did, that investors did was critical in that, the prep work that was done in advance. The one more concrete change, and I in particular, I'd say this personally, from speaking now from the Paris office rather than London office, where I've historically been based, has of course been people changes, in particular on the DCM sales and syndicate side, where we've seen across the street a large number of people moving to Frankfurt and Paris. That's a big impact on those cities and those people, but I think it's actually added a huge amount of diversity to the market, and actually it's a pretty healthy development. May not be what we all were looking to have 5 years ago, but from a market health perspective, it's quite helpful, I think, to have London, Paris, and Frankfurt, amongst other cities, as European hubs for the primary markets.
Okay, thank you. Okay, so that links in with another topic that I think is really important in terms of regulatory issues affecting primary markets. And post-Brexit, we have already started to see some moves, not yet anything concrete, but some moves that might result in divergence in EU and UK regulation. I don't think we've got time, unfortunately, to go into a huge amount of detail on that now. And I would like to move on to another very significant regulatory development in Asia Pacific and bring in Liang to update us on Hong Kong's proposed code of conduct on book building and placing. It's a quite broad-ranging and indeed far-reaching proposal. But Liang, could you perhaps give us an overview on some of the key points that we should note?
Sure, thanks, Charlotte. Indeed, this is a hot topic in Asia now. Perhaps I take a step back first to give a bit of background on this topic to the audience. As we know, globally, the conduct of intermediaries in capital markets has attracted lots of regulatory attention. At the moment, there are no specific requirements governing the conduct for book building and placing activities by intermediaries in either debt or equity markets here in Asia. SFC is Hong Kong's independent market regulator. So they did a thematic review and identified major problems in a few areas that could potentially impact the fairness and transparency of such activities. So in February this year, SFC issued a consultation paper on conduct requirement, which should serve the interest for both investors as well as issuers for primary transaction. The proposed requirement will basically help clarify the roles played by the intermediaries, also set out the standards of conduct expected of them in the book building, pricing, allocation, and placing activities. The conclusion is expected to come out as early as this month, certainly within this year. Once the final version is published, currently it's not published yet, the intermediaries are likely to have a few months of transition period, maybe not as long as Brexit, 2 years, but likely 6 months for putting various internal guidelines of operation procedures in place for implementation. Some of the areas we expect the code to cover from DCM perspective include, first of all, scope. There has been discussion on this code to apply to all the book building and placing activities conducted in Hong Kong. And given the global nature of the transaction nowadays, this potentially means lots of the global deals will be in scope as well. Hence, it's important for global bond market participants to be aware of this development and all the intermediaries to have frameworks and procedures in place for that. The second aspect that is appointment and formation of the syndicate, which include the creation of overall coordinator role and increased responsibility for the intermediaries. It also requires roles and fees to be determined early and documented, which wasn't the case in the past for lots of the regional deals. They also cover order placement and order book management, for instance, how to deal with account X orders, which in some cases has been misused or misrepresented, allocation policy, conflicts of interest management, things such as priority to client orders over your own prop orders. There's also investor assessment on investigating unusual orders and ensuring order placed that is represent bona fide demand. There's also reforms of rebates. The issuer of rebates should not be passed on to investor clients, and there shouldn't be any undisclosed rebate which happens in the region. Also about regulatory reporting, record keeping, etc. So these are just few examples. Overall, the code of conduct are basically, I would say, safeguards to promote the fairness and transparency in the Asia primary market. I would say most of the market participants are supportive of these measures. It's likely to be one of the biggest topic for Asia DCM scene next year. Also worth mentioning, ICMA has been actively engaged with SFC as well as industrial stakeholders in formulating the industrial response to this consultation, basically taking the lead from DCM perspective and liaising with various market participants, providing input and feedbacks. We also have multiple topics covered and discussed in length in our regular meetings. And the idea really is to reflect from the market view and represent the industry on matter that is DCM related. So this is definitely, I would say, one of the key regulatory development in the region.
Okay, thank you. And in the couple of minutes remaining, Mark, from an EMEA perspective, obviously you're aware of this proposed code, will it have an extraterritorial impact, do you think? Do you think it will be something that people in Europe will also need to be aware of?
Well, I think it's unclear exactly, Charlotte, what the final outcome will be, as Liang said. But I think it's important that we, on the European side, are focused on the final wording that comes out and the potential for extraterritorial scope and what that means in terms of global offerings that are offered to Asia. Obviously, we're in an increasingly globalized primary market, and it's been great to see that develop over the last decade with a lot more Asian investor involvement in European and US issues and vice versa. So it's important that I think we're all sort of vigilant and make sure that we work out how the new regulations can impact that.
Great, thank you. I wish we had more time to cover numerous other issues that are affecting primary debt capital markets. But I think we're drawing to a close now. And I'd just like to thank all the panelists for their remarks and contribution today. Really, really interesting. And obviously, if anybody has any questions, please do not hesitate to contact ICMA staff. We have seen a couple of questions pop up on the chat, which I don't think we've got a huge amount of time to cover now, but we'll try to get back to you bilaterally on those. So I'll finish there, and thank you very much, everybody.
Thanks, Charlotte, and thanks also to all the panel for that, again, very, very rich discussion. I think, we talked for many years around the cyclical change, inflation, higher rates, the reversal of central bank support. I think it's an ongoing topic, but it looks now that it's becoming very real, and I think we are entering a new phase. In terms of the market technicals, and certainly the dynamic probably between the debt and the equity markets at a higher level, and also the impact on some of the more yield-sensitive segments of the market, such as long end, I think as was mentioned, the high yield segment, obviously bank AT1s, certain parts of the emerging market. So it's going to be an interesting period as to how that settles down against the backdrop of a new market economic backdrop. We talked also, I think Frank mentioned on the importance of the short end of the market as a reliable source of liquidity and the need for consistency there. I do think we need to look at the primary markets as a whole, which does obviously incorporate the short end as well. It's the lifeblood of efficiency and corporate liquidity at the end of the day. I would again like to extend my thanks and congratulations to Richard and the EIB team on their successful deal. I think, again, digitization is key to everything. Process and development for standardization are critical there. And it was very clear as to the magnitude of the challenges that EIB and the whole team there, I guess, faced through every step of that process, be it around new product approvals or potential new product approvals, jurisdiction of usage, custodies, technology more broadly, relevant funds from the investment side to be able to house the product, etc. Very, very interesting. We've obviously got a long way to go there, but I think EIB helped us take a huge leap forward with a lot of great learnings to come out of that. And I think Armin and Rory will be talking in more depth on technology in a moment, which we're all looking forward to. Finally, as well, while I think the market fundamentals are strong, we do have some of these issues from a regulatory and a consulting process standardization line of sight as well. Clearly, there are potential unintended consequences around some of these divergences or some of the new rules and recommendations that some of our regulators are looking to put in place. And while the intent, I think, there is always positive, sometimes the outcome is not. And I think that's why ICMA can play a very important role, along with all of you, to supporting the views of the market and ensuring that regulation embeds itself in an efficient and positive way. So with that, Rory, I will pass over to you for your discussion with Armin around technology and primary markets. And I think we're all very much looking forward to this. Thank you.
Thank you very much, Brian. I'm Rory Ewing. I'm Secretary to the ICMA Primary Market Praxis Committee. And I'm joined now by Armin Peter, who's a syndicate practitioner at UBS, and who also, apart from being a PMPC member, is the chair of the ICMA FinTech Advisory Committee, FINAC. Now, we have just 20 minutes, actually a bit less now, to run through various topics on the FinTech side. So what I would do is I would encourage people to post any questions in the chat, and we'll try and keep an eye to them, but I can't guarantee that we'll necessarily be able to address them or get to them. We'll try and have a quick look perhaps at the end, but again, to the extent that we can't, we'll pick up, try and pick up any questions bilaterally thereafter. So with that, thanks Armin for joining. And I suppose in terms of starting off our discussion, I suppose that the kickoff question is basically, how do you see the current landscape in terms of primary market solutions that are currently out there?
First of all, thank you very much, and thanks for having me this morning. And Rory, I think we already learned a great deal in terms of what's happening in the primary market, and from a technology perspective, just to touch on, the last panel where we learned about the EIB transaction from a product perspective. That gives you a very good feeling that that things are moving forward. It's not, looking in how the, brakes or the wheels are working independently on a car. It's how to bring it actually together. And I think in that regards, again, we are in an evolving space. I wouldn't say necessarily we have managed to, execute on a revolutionary implementation of a new market infrastructure. But certainly, more and more, I would say, things are coming more and more together. If that is probably the right way of saying. So people do understand there are the wheels, people understand there are the brakes, but to the same point of what we heard from the EIB, Richard highlighted the fact, the desire of EIB to bring things together. And I think that is a common desire that is now shared out there. There has been times where, FinTech and advisors and technology have tried to look at this topic in a way of the winner takes it all. I think that is now very well understood that any, change in market infrastructure is something that we need to do together. And therefore, there is a great deal of interest now by all market stakeholders to collaborate and try to implement a back to front process. That's probably in a summary of what I would say, where we stand and what we have seen over the course of the last 12 months, and in particular, driven by the COVID environment. I think that was an additional booster, so to say.
So in terms of because obviously we're going to come on to some of the very new solutions, which are the all-in-one solutions in terms of fintech. But I suppose there is that sort of transitional, well, not transitional, that's not quite fair, but solutions which look more to perhaps the conventional processes and adding efficiency to conventional processes, and sort of looking at some of them, most of them I think are perhaps looking at specific areas of the process and adding efficiency there. And that's that there is the potential for them to communicate, I suppose, with each other. So how would you perhaps break down the kinds of solutions which are currently there and sort of more or less what they do from in that perspective?
It's quite interesting. You hesitated on using the word transition, but I think it's all part of a transition, and probably in that, probably more the early part of a transition where, again, people are looking at the different parts of the process before trying to make them interoperable and bring them all together. I think there's a complication as well that each and every part of the step has been focused by an individual company, and then there are certainly the commercial considerations of how to bring these companies together to make it one process. And again, I would say from a technology perspective, a lot of things can be possible. I think the devil is more or less in the implementation. The way I see it is actually, you are absolutely right. People are focusing on different parts of the process from an origination perspective. What needs to happen on the DCM floor to win a mandate? What are those ever repeating processes that can be automated and brought together and become more efficient? There are the steps of marketing a transaction, again, in the run-up of a deal. There are the legal consideration. It's quite interesting to hear from Dan from Euroclear that in case of implementing a new infrastructure or a new model, you actually need to start with the legal side of things, and I think that is something that we started to feel as well. And then certainly the book building process. It's interesting that Asia and Hong Kong is looking into the code of conduct. I think things are working globally speaking very, very well. Yet, I think the regulator has started to take a hand on these processes as well, which is not necessarily a bad thing always. To the point of Brian saying, you want to prevent the unintended consequences, absolutely right. But I think in finding common standards and common understandings, it's probably sometimes not a bad thing. So I think, again, to the point, I think it's the start of a transition. It belongs that each and every part is understood. The key will be to bring them all together.
Indeed. I mean, it's interesting because from my perspective, obviously, I'm not frontline like you, so I sort of tend to see things from more of a secondary stage. And I find it very interesting because I see, as you say, solutions on the origination side, some existing solutions, and some have been long running on the book building side. Because one of the key things originally was coordinating the bank's views of the order book, and you've got sort of legacy solutions out there which are in use, and you've had some recent entrants joining in that market from the US. So those things are up and running, and it's interesting because in a way, and you've also got private placement platforms, and then each of these platforms, and then platforms which focus on marketing or on road shows, and they're sort of perhaps not quite. I mean, the connections. I think you were mentioning the connectivity aspect and the concerns on fragmentation. I think it's interesting because solutions, I suppose, they come up, they show extra efficiencies, but also you spot then where further efficiencies could be, and I suppose you notice something which is not new fragmentation. It's just you see the possibility of fragmentation that could be actually resolved in terms of linking up these systems to talk to each other, and not just from primary, but I suppose also through to secondary clearing, back offices of investors, and so on. So I think that's something which is becoming a bit more of a focus now, isn't it? That sort of link up.
You're absolutely right, and I think this is where hopefully in the next 12, where we're going to spend the next 12 months. If the last 12 to 18 months we spend a lot of understanding each part of the steps, and more and more companies have been coming up, and Brian mentioned, ICMA is collecting all the upcoming fintech solutions in the secondary market, but in the primary market as well, where he highlighted, in the meantime, there are 50 different startups and fintechs who are looking into the primary space. So we are not short of any technical solution, I would say. What we are short of is right now really to align them together and make an interoperability possible. And address really the implementation. So there has been products, which gone live, which 12 months ago we were talking about. You mentioned, US, and I would say Big Book Builder system, Direct Book is to be mentioned, as we've been using, IBRIOS and now IHS Market platform for many years here in Europe, and has been becoming a global dominant provider of book building system. So some products gone live, others are expanded and started to collaborate in the MTN and private placement space, even in the market infrastructures consideration. Some companies started to merge, and I think this kind of merger gives another example of that things are coming together. People do understand, you need to connect. So these kind of mergers where IHS Market has been taken over, IBRIOS, IssueNet, or Liquidnet of recently going into TPI ICAP. I would say that is certainly, again, a reflection of the next stage of the transition, and I'm not hesitant to use that word. And then there are other new platforms that come forward, Bond Auction, FinSmart, Bots, just to name it, a couple of those. They are looking at different parts, in the run-up of a book building. So again, I think particularly the fact that some companies are expecting their product offering, and some others are actually even merging. I think we are firmly into the next phase, which hopefully will be the dominating theme in the next 12 months, where we're trying to integrate and to make the next steps towards a change in market infrastructure and working processes.
I mean, in terms of trying to encourage that, the transfer, the connectivity, because what you don't want is finding that stakeholders, participants, be they issuers or be they investors, find that there's inefficiencies because they haven't connected to all the platforms. So that apart from sort of, vertical data flow from primary to secondary and so on, the potential for even conceptually horizontal. I mean, obviously a lot of these involve commercial decisions, and that's the choice for the individual, platforms in terms of connecting. But obviously if they choose to connect, we want that connectivity to be as streamlined as possible. And one of the things I'm conscious of is in the primary market, unlike certain other spaces, we don't have certainly in terms of the actual what a bond is, we don't have master agreements as we do, for example, for derivatives. Very, very similar, leaving aside certain very specific structural points, but they're not verbatim the same or based off one common master. And there's a lot of, these current, issuance platforms effectively belong to the issuers, to the borrowers concerned. And obviously they have, maintaining or upgrading their borrowing platforms for pure market, efficiency on the financial market side is not their core focus. Their core focus is manufacturing widgets or whatever it is that they do. And so there's a very, important aspect there in terms of, bandwidth and resource from that end of the spectrum. I see that many platforms, and systems have databases. And databases as well is something quite challenging. And I've heard this idea of just enabling the rather than focusing on a front end definitional or a retooling of the systems, that you just have effectively like a multi-plug connector kind of thing. And I'm just wondering what your thoughts are in terms of the potential for this, and presumably that's something that the providers need to come together to do and to talk about, at least enough of them to make it worthwhile and start giving it critical mass.
You're absolutely right. I think this lack of master agreement, let's use that term, is one of the key reasons why we didn't make yet, the revolutionary next step into changing of a market infrastructure. Not in the process and not necessarily in the product. It's great to see these developments, EIB, but then, Frank from DWS was mentioning, the secondary market. It needs to go into lockstep. Yet it all starts, I always like to say, at the birthplace. Brian was mentioning the life cycle. A life cycle starts with birth, and therefore it starts with a common denominator. Which is, with other words, actually what you're mentioning. It's a the market or the channel market agreement on certain terms which will be used throughout the life cycle. I think in this regards, we're really excited about actually two developments. The one is the CDM, which originally been focused on the derivative world, driven by ISTA. As most participants at this conference gonna know, that ICMA has engaged together with ISTA and ISLA actually to work and expand the work of the CDM model towards repo. The next step's going to be going into bonds, because you can ask anyone and everyone out there, the fintechs, any stakeholder. I think everyone talks about the market standards and standardization that is required to make the next step. You see in the sustainability space as well. Our colleagues earlier on the call use the word of standards very often as well. So CDM is something which, this commonality, this master agreement is really something which we're going to spend a lot of time on going forward, trying to, engage with all the stakeholders and get them on board, because everyone talks about standardization, yet, you need some leadership. I think the other excitement, I would say, is the ECB's DICMG. I have to say, that I got really excited about the fact that more or less a regulatory body is looking into exactly the same things. They do understand that they need the standards. Yeah, code of conduct review by Hong Kong is one way of engagement. People do care, and I think it is a requirement going forward to determine standards. Yeah, once the regulators and others, want to have these standards as well because they see the benefits, I think that will be the key. So the combination of the work we do around the CDM and the work actually regulators start to do on this topic, I see it rather positively, because it will drive things forward. To the point of what Brian says, to mitigate the unintended consequences, one needs to be early at the table, and in that regards, I'm glad to say that that ICMA and we, with all the working groups from the PMPC as well as the FinTech Advisory Committee and up to the board of ICMA, we are fully engaged with the regulator on these topics.
Yeah, I mean, it's interesting times, and I'm conscious we've only got, I think, a couple of minutes left on this, but it's interesting because what I'm seeing in a way is we've got lots of choice that's coming down the line, and I think from a market development perspective, choice is good. There are challenges, but it's good, and it's choice both coming from the traditional side of improving, effectively non-DLT based systems and connecting up non-DLT based systems, as well as the development of DLT systems and connecting, and standards in that context. So we've got sort of two tracks which would even connect up and overlap and work efficiently together. So I think it's quite interesting times in that respect. The interest of the authorities is also interesting because yes, that gives us extra focus and so on in our mind. But I suspect it's still it underlines the importance of the market working together to try and come up with solutions in this respect, and therefore ICMA's role, in that, in terms of the CDM, as you've mentioned. I mean, just very lastly, I think we've just got 1 minute to go. It's in terms of the future, I suppose. Here's the random question: horizon time of this process, which is a continuous one. Do we think we're going to, in a year's time or 2 years' time, we're going to be incrementally further where we are, and it's probably more like 5 years or more before we really get seeing something fully significant and beyond where we are now?
No, I really think the pandemic has, coming out of the pandemic, we really have learned and felt it now in all organizations, how much on the tech side of things people woke up. Yeah, things are possible. You want to enable people. And in this regards, if there is one play I would have to everyone, this is coming faster than you believe. Engage, be on top. I think the recent discussion on CBDCs, is another topic. I see it now coming into treasury departments of that discussion. And the three layers of process together with product and even the merits of combining this with a new form of cash, to the point of settlement of the EIB transaction, just shows you things have come more and more together. So it's time to engage, and with the engagement comes, of course, then the implementation as well.
Well, all I can say, Armin, is thank you very much for joining me for a brief chat, and thank you to the audience for your time. And so with that, I will hand back to Brian. Thank you.
Rory and Armin, thanks very much for that. Again, extremely insightful. I think, today we've really enjoyed very lively discussions and important topics across the board. We've covered sustainable finance, fintech and digitization, and then market technicals, fundamentals, and documentation and process side of things. I think what's really clear here is that the common threads and the common themes are around frameworks and the importance of having a strong base and a consistent approach in many ways to help drive efficiencies and not lead to fragmentation. And that, again, it centers on the developing infrastructures and processes that can operate well together. At the same time, clearly, we have to adapt to regional and segmental divergences and take those divergences and differences into account, but at the same time, hopefully bring things together in as much of a framework and standardized way as possible to ensure that we have consistency and interoperability to maximize the efficiency of the market. In terms of wrapping up, I would very much like to thank Leanne and the events team here at ICMA for their great work in bringing this together, and to everybody on the call as well for your participation, but certainly to all of the panelists and moderators for their great work. Look forward to, just in terms of final remarks, to the primary market side of ICMA being very lively through the course of next year. There's a lot of good work to be done. We're hopefully going to do next year's event in person. That's kindly going to be hosted by Linkletters, so we very much look forward to that. And thanks again for your time today.